Hello everyone, and welcome back to another episode of Maximize Your ROI with Don Mancini. Today I want to talk to you about recourse versus non-recourse financing. So many of you out there might be familiar with this concept, but when you go to get a commercial loan, you have the option, depending upon your present property situation, of either getting a recourse mortgage or a non-recourse mortgage. My experience is most of my clients don't even know to ask for non-recourse financing. But the difference between recourse and non-recourse is absolutely dramatic. In a recourse loan, the bank can come after the borrower and all of the borrower's assets in the event of a default on the loan of the property. So that means that your 401k, your checking accounts, your cars, all of that get brought into play. And even if your property is not in a state of default, you have that contingent liability hanging out there where if something outside of your control happens and there's an economic crisis and you lose some tenants, you have that lingering risk for the entire duration of the loan. A non-recourse loan is where the bank agrees up front that in the event of a borrower default, the only credit the bank can go after is the equity that remains in the property. That's it. They can't come after your cars, they can't come after your bank accounts, they can't come after your cash, your retirement funds. All of that is essentially off the table. And friends, non-recourse loans are really the only type of loans that I recommend, except in a few rare circumstances where recourse is the only way we could possibly structure a loan. So what does it take to get non-recourse financing and how do you ask for it? Well, those are some good questions. I want to talk about it real briefly. So non-recourse loans usually end up landing somewhere in the 50 to 70% loan-to-value ratio. 50 to 70%, which is a wide range, and there's other factors that come into it. But once you get over a 70% loan-to-value, you're not going to qualify for a non-recourse loan, and that's where a recourse loan becomes your only option. The other thing is from a debt service coverage perspective, banks are really looking for 1.25 to 1.3 times as it relates to a threshold to provide you with a non-recourse loan. In addition to that, they're going to want to make sure that the property is stable. So not a lot of lease expirations during the term, no real capital needs over the term. So your roof needs to be in pretty good shape, your asphalt needs to be in pretty good shape, your credit must be very, very solid. And you have to be a proven borrower. You have to be someone that has owned a couple of properties, has a proven track record of success, and someone that the bank can get on board with and get behind and know that the probability of you being able to honor this debt that you're asking the bank for is going to be pretty high. As it relates to the terms, I would tell you that the terms between a recourse loan and a non-recourse loan are going to be virtually the same. You're not going to pay a higher interest rate, most likely for a non-recourse loan. You're not going to get a shorter amortization on a non-recourse loan. You should be able to negotiate the same terms and conditions that you would in a recourse loan, but because the bank is taking less risk because you have more equity in the deal, less risk because the property is a better property, it doesn't need capital repairs and improvements. Because the bank is taking less risk, they then can offer you a non-recourse loan, and that's where you need to be if you really want to maximize your ROI, because you're eliminating contingent risk and contingent liability that could come back to bite you at some point down the road. So guys, when you go to the bank, you know what you're asking for, a non-recourse loan, provided you check the boxes we talked about here, and that's the way that today you can maximize your ROI. Thank you.